Did you know individual investors often underperform the market by nearly 4% a year? Over decades, that gap can mean the difference between a comfortable retirement and working far longer than you planned. Millions lose out quietly, year after year, because of simple avoidable mistakes. Are you one of them? Facing this reality is the first step to changing your financial future. In this video, I'll break down the 7 most common investment mistakes and show you exactly how to avoid them. Ready to stop losing money and start building real wealth? Let's dive in. The biggest wealth destroyer? Emotional decision-making. It's not the market's ups and downs that do the most damage, it's how we react to them. Our feelings left unchecked can quietly sabotage years of hard work and smart saving. When your stocks soar, you feel invincible. Greed takes over, and you buy more at the top. It's easy to believe you found a winning formula, and the temptation to double down is strong. But this euphoria is a trap, luring you into risky decisions just when prices are highest. When markets crash, fear kicks in, and you panic sell at the bottom. The pain of seeing your portfolio shrink can be overwhelming, making you desperate to escape further losses. But selling in a panic often means locking in those losses for good. This cycle, buying high, selling low, guarantees losses. It's the opposite of what successful investors do, yet it's a pattern that repeats for countless people, year after year. In 2020, those who sold in panic locked in losses, while those who stayed the course saw their portfolios recover and grow. The market's rebound rewarded patience, not panic. History is full of these lessons, but they're easy to forget in the heat of the moment. Our brains are wired for fight or flight, not investing. We're built to react quickly to threats, not to calmly ride out volatility. This ancient wiring can make us our own worst enemy when money's on the line. The market doesn't care about your feelings, it moves on data, not emotion. No matter how anxious or excited you feel, the market keeps moving, indifferent to your personal story. So how do you protect yourself? Build a system. A system acts as your shield, keeping your emotions from hijacking your decisions when things get turbulent. Create a written investment plan, your rules for asset allocation, contributions, and rebalancing. Spell out exactly how you'll respond to market swings before they happen, so you're not making choices in the heat of the moment. When greed or fear strikes, your plan keeps you anchored. It's your personal guide, reminding you of your long-term goals and the logic behind your strategy. It reminds you not to chase hot stocks or bail out during downturns. Instead, you stick to your process, even when headlines scream otherwise. Outsource your decisions to your rational self before emotions take over. By setting rules in advance, you make it easier to act wisely when the pressure is on. Successful investing is boring. Set up automatic investments, then ignore the noise. Consistency beats excitement every time, and automation helps you stay on track. The less you check your portfolio, the better you'll do. Constant monitoring only fuels anxiety and tempts you to tinker with your plan. Let your system work, and keep your feelings out of your finances. Trust the process you've built, and give it time to deliver results. This one change can transform your results. Over time, discipline and patience will do more for your wealth than any hot tip or market prediction. Don't gamble with your future. Invest with discipline. Treat your investments like a business, not a lottery ticket. Stick to your plan, and let time do the heavy lifting. The real magic of investing is in compounding, and that only works if you stay the course. Remember, emotions are your enemy in the market. Build habits, not hunches. That's how you win. In the end, your future self will thank you for every calm, disciplined choice you make today. Investing without research is like buying a house without seeing it. Many throw money at hot tips or social media hype, hoping for a quick win. That's not investing, it's gambling. If you don't know what a company does, who its competitors are, or how it makes money, you shouldn't own it. The same goes for funds. Don't buy based on a catchy name. Check what's inside. When you skip research, you lack conviction and panic at the first sign of trouble. Real investors know what they own and why. Before you buy, ask. Can I explain this investment in simple terms? Do I understand the risks? If not, do more homework. Invest like a business owner, not a gambler. Your future self will thank you. Trying to time the market, buying at the bottom, selling at the top, sounds great, but even the pros can't do it consistently. You have to be right twice, when to get out and when to get back in. Miss just a few of the market's best days, and your returns plummet. Data shows. Staying invested beats jumping in and out. Dollar cost averaging, investing a set amount regularly, removes the guesswork. When prices are high, you buy less. When they're low, you buy more. Over time, this smooths out volatility and builds wealth. Don't stress over headlines or try to outsmart the market. Focus on time in the market, not timing the market. Consistency wins. Set your plan, invest automatically, and let compounding work for you. Ignore the noise. That's the real secret to growing your money. Diversification protects you, but overdoing it can hurt. Owning a dozen funds that all track the same index, that's not diversification, it's complexity. Or, buying hundreds of stocks you can't track waters down your best ideas. The goal isn't to own everything, it's to own a sensible mix of assets that don't all move together. For most, a few broad index funds, US, international, and bonds, cover thousands of companies and keep costs low. If you pick stocks, focus on a handful you truly understand. Every investment should have a clear purpose. Simplicity beats chaos. Good diversification protects you from disaster. Over-diversification protects you from success. Review your portfolio. Is it intentional or just a collection of random bets? Be deliberate. Less is often more. Make every holding count. Fees are the silent killer of investment returns. They quietly erode your wealth, often without you even noticing. While you focus on market swings and investment choices, fees work in the background, slowly draining your gains year after year. A 1% annual fee may seem small, almost insignificant at first glance, but over decades, that tiny percentage can snowball into a massive loss, costing you tens of thousands, or even more, depending on your portfolio size and how long you invest. High fees compound against you, just like returns compound for you. The longer you invest, the more damaging those fees become, eating away at the power of compounding that should be working in your favor. Many funds and advisors bury fees in fine print. Don't let them. Always read the details, and don't be afraid to ask for a clear explanation of every charge. Low-cost index funds often charge a fraction of what active funds do, yet most active funds don't outperform. Over time, those lower fees can make a huge difference in your final returns. Every dollar you save in fees is a dollar that keeps working for you. It stays invested, growing and compounding, instead of being siphoned off by hidden costs. Always check the expense ratio, trading costs, and advisor fees. These small numbers add up, and being vigilant can save you a fortune over your investing lifetime. Ask questions. This is your money. Don't hesitate to challenge unclear charges or seek out lower-cost alternatives. Minimizing costs is the closest thing to a guaranteed win in investing. Be a fee detective, scrutinize every statement, and look for ways to reduce unnecessary expenses. Hunt down hidden charges and cut them out. The more you trim, the more you keep for yourself and your future goals. The less you pay, the more you keep. Over time, these savings can mean the difference between just getting by and truly building wealth. That's money in your pocket, compounding for your future. Make every dollar count by keeping fees as low as possible, and let your investments work harder for you. Herd mentality, chasing what everyone else is buying, leads to bubbles and painful losses. FOMO makes you buy at the top, just as the smart money is selling. By the time an investment is everywhere, the big gains are gone. This isn't just meme stocks, it happens in every bubble, from dot-coms to crypto. Warren Buffett said, "Be fearful when others are greedy, and greedy when others are fearful." Think independently, do your own research, and stick to your plan. Don't let hype or social media drive your decisions. Curate your information. Follow rational voices, not the crowd. Investing rewards contrarians, not followers. When everyone's panicking, look for bargains. When everyone's euphoric, be cautious. Walk your own path. The root of most investment mistakes? Not having a plan. It's the silent trap that catches even smart, well-intentioned people off guard. Without a clear plan, you're left guessing, reacting, and hoping for the best. never really in control of your financial future. Without a plan, you're tossed around by emotions and market swings. Every headline, every market dip, every rumor can send you into a panic or tempt you to make impulsive decisions that hurt your long-term results. A real plan is written down, something you can refer back to when things get tough, not just a vague idea in your head. Your plan should spell out your goals, your time horizon, your risk tolerance, and the rules you'll follow for investing. It's your personal roadmap, tailored to your life and your dreams. It tells you what to buy, when to buy, and what to avoid. It helps you filter out distractions and focus on what really matters. And most importantly, it tells you how to react in a downturn. Meet Sarah and Tom, two investors with very different outcomes. Tom chased trends and panicked in downturns. His portfolio went nowhere. He was always reacting, never leading. Sarah, on the other hand, set a clear plan, invested automatically, and stuck to her strategy even when the market got rough. She ignored the noise. Her wealth grew steadily, year after year. She didn't let fear or hype dictate her moves. Your plan is your anchor. It keeps you disciplined, forces you to research, and gives you confidence when others are losing theirs. It protects you from emotional mistakes, like panic selling or chasing the latest hot stock. It's your safety net in a world full of uncertainty. Take an afternoon to write your plan. Ask yourself, what are your goals? What does financial success look like for you? How much risk can you handle? What's your strategy for staying on track when things get tough? Keep it simple and low cost. Complicated strategies rarely outperform a disciplined, straightforward approach. Review your plan once a year, not every day. Let it guide you, but don't obsess over every market move. This document is your most valuable asset. It's more important than any single stock or fund you own. It's your shield against chaos, your defense against making costly mistakes when emotions run high. Don't invest without a map. Define your path and stick to it, even when the journey gets bumpy. That's how you build lasting wealth. Make your plan today and let it guide you to the future you want. Your future self will thank you for the discipline and clarity you create now. Those are the 7 deadly sins of investing, and how to avoid them. Each mistake seems small, but together they can cost you a fortune. Now you know what to watch for and how to take control. Investing success isn't about genius, it's about discipline, patience, and a clear plan. Focus on what you can control and let the rest go. Which mistake have you made? Share your story below. We all learn together. Thanks for watching. Check out my next video on building a simple 3-fund portfolio to put these ideas into action.